Have you ever looked at a stock price and thought, is this expensive or cheap? That's where the P/E ratio comes in. It's one of the most common tools investors use to get a quick idea of whether a company's stock is overvalued or undervalued. P/E stands for price to earnings. It compares the price of a company's stock to how much profit the company makes per share. In simple terms, it tells you how much people are willing to pay for $1 of that company's earnings. Let's make it even easier. Imagine a stock is priced at $100, and the company earns $5 per share. You just divide the price by the earnings. So, 100 divided by 5 equals 20. That means the P/E ratio is 20. What does that mean? It means investors are paying $20 for every $1 the company earns. If the P/E is 10, they're paying $10 for each dollar of earnings. If it's 40, they're paying 40. So the higher the number, the more expensive the stock is relative to its profits. But here's where it gets interesting. A high P/E ratio doesn't always mean the stock is too expensive. Sometimes it means investors expect the company to grow a lot in the future. They're willing to pay more now because they believe earnings will rise later. On the flip side, a low P/E could mean the company is cheap and potentially a good deal. Or it could mean the market doesn't expect much from it. Maybe earnings are going down. Maybe something's wrong. That's why the P/E ratio doesn't give you the full story by itself. It's a starting point. You have to look at other companies in the same industry. If most companies in that space have a P/E of 15 and one has 30, you should ask why. You also want to compare it to its own past. Has its P/E been rising or falling? And most importantly, does its future growth match its price? At the end of the day, the P/E ratio helps you ask a simple but powerful question. Am I paying too much for this company's profits? It doesn't give the answer, but it makes you pause and think. And that's the first step to smarter investing.